person included in assessee's total income, which is nothing but the clubbing of income, right? So by now you have finished all the heads of income, right? And what are we seeing now is basically the clubbing of other person's income in our hand. Now, what is the logic of that? Can anybody tell me? You have also done this little bit in IPCC as well, I understand. But what is the logic of clubbing other person's income? So see, section 4 says total income of a person shall be charged or assessed to tax in the next assessment year. So it says total income of a person. Now why am I being assessed for other person's income? To avoid
Diversion
tax
of
evasion.
funds. Diversion of funds.
Yes, diversion of funds. That's right. Yes, to avoid tax evasion practices. That's right. So that person with the higher income does not transfer some of his income to another person with lower income to reduce his tax. Yes, that's right, Megha. Yes, so all the answers are correct, right? So this is a particularly specific anti-avoidance rule. What is it? Specific anti-avoidance rule. We may call it as SAR. Specific anti-avoidance rule, we may call it as SAR. Okay, so you will be studying SAR and GAR. This is one of the SAR, where what happens is that there are people who would want to avoid their income tax liability. It's very common, you would have seen in your articleship days also, that there are taxpayers who will say that okay, I have a lot of income, because of which there is a lot of tax which is coming in my name. So can you show this income in my wife's name, in my husband's name, in my mother's name, father's name, right? They try to transfer the income to the other person, isn't it? So when they transfer the income to the other person, in that particular case, this particular clubbing provision comes into picture. Are we clear? Okay, so this provision consists of different clubbing of income provision. We are going to have a look to it one by one. Okay, so let us start with the first section, which is the 60. Section 60, transfer of income without the transfer of the asset. Transfer of income without the transfer of the asset. So which means what, students? That you have transferred the asset to the other, transferred the income to the other person, but you have not really transferred any asset to the other person. Are you getting this particular point? So I have transferred the income, but I have not transferred the asset. So in that particular case, there is still the income should remain taxable in my hands. The income should remain taxable in my hands. Yes or no? Because I have not transferred the asset. I have only transferred the income. So if I have transferred the income to the other person and I have not transferred the asset is still owned by me. I am the legal and the beneficial owner of that asset. So in that very case, the income should be taxable in my own hands only. So let us look at this particular section once again. Sorry, let me just reshare the screen where I can edit the PDF as well. Yes. Yeah. So if you look at it, it says section 60, if any person transfers the income from any asset without transferring the asset itself, then in that particular case, what happens? Such income is to be included in the total income of the transferor. Such income is to be included in the total income of the transferor. Right? So this is what is important for us. Right? Now it is immaterial whether the transfer is revocable or irrevocable. Now, what is a revocable transfer and what is the irrevocable transfer? What do we mean by that? What is a revocable transfer? Any idea? Revocable
It
means
can
in simpler. Yes,
it
please go ahead.
it it can be retransferred to the transferor
Correct.
in any other
So
form.
the transferor has the right to take the transfer back. Irrevocable means it cannot be taken back. Right? We will understand again in next 5-10 minutes. You will understand what is revocable, irrevocable in detail also. Now, whether the transfer of the assets is revocable, irrevocable, right? That doesn't matter. Or the transfer of the income in that way. If you have not transferred the asset, the matter ends, the income will be included in your hand. Income here also includes the losses also. So it's not that the government is only going to add your income. They will also allow you the losses. So if you see they have given here the example. What does the example say? Mr. A confers the right to receive in rent in respect of his house property on his wife without transferring house itself to her. In that case, the rent received by Mrs. A will be clubbed in the hands of Mr. A. Are we clear? Yes or no? So this is very, very important, students, that you have to understand this particular point, that whenever you're not transferring the asset but only transferring the income, in that case, this will not be considered as the income of the transferee. It will be the income of the transferor itself. Clear? The second one, if you look at it here, income arising from the revocable transfer of assets. Now, what do we mean by the revocable transfer of asset? We just now discussed. What we discussed, that where the settler, where the transferor has the power over the asset, that he can, take the asset back. So 61 says this, that all income arising to any person by virtue of a revocable transfer of asset is to be included in the total income of the transferor. So means that if you are, transferring the asset for the saying that, okay, you are telling me income tax, that if I do not transfer the asset, you will club the income in my hand. Okay, I'm transferring the asset. But the transfer is made in a such a way that tomorrow I can claim back the asset. I as a transferor have the right to claim back the asset. Right? So in that particular case, it is actually not the transfer. Right? This is not actual transfer. This is just that for the purpose of coming out of the clubbing, I'm saying that, okay, I'm transferring. But in that case, it is a revocable transfer. Now, what is revocable transfer? It says revocable transfer means transfer is deemed to be revocable if it contains any provision for the retransfer directly or indirectly of the whole or any part of the income or assets to the transferor, or it gives in any way to the transferor a right to reassume the power directly or indirectly over the whole or any part of the income or the assets. Okay? So either it contains the provision of retransfer or it gives the transferor right to reassume the power indirectly or directly over the whole or any part of the assets. Are we clear? So once the transfer is revocable, the income from that transferred asset will be clubbed in the hands of the transferor. And even when part of the income of the transferred asset has been applied for the benefit of the transferor, the clubbing provision will still be applicable. So let's say for an example that where I have transferred the asset, but the asset is not, I will take back. I am still taking back my income. Let's say for example, I have transferred the house property, okay, to my wife or to my husband, okay. Now, in that particular case, I'm not having the power to take back the house property, but I'm saying that whatever rental income will be generated, you will pay off all my bills from the rental income. In that case, the rental income will be clubbed in my hands. Or I'm saying that, okay, whatever rental income you will earn, you will give it back to me. In that case, the clubbing provisions will become applicable. Are we understanding about this? So, the person with the higher income does not transfer some of his income to another person. Okay, yeah, this so we discussed Mega.
Ma'am, I have one question, query
Yes.
actually. In section 16 also talk about the revocable and irrevocable. Then why there is a separate section for irrevocable for that section 62, 61?
60, yeah. 60 talks about where the asset is not transferred. In that case, the income from that asset, the asset remains with me. I'm only transferring the income. 61 says that when you do a transfer, but it's a revocable transfer, and 63 defines what is a revocable transfer. So 60 says when the asset is not transferred, only income is transferred. 61 says where the asset is transferred, but it's a revocable transfer. In that case, we will consider the income in the hands of the transferor. Clear?
Okay, that is 60 talks about the income only transferred.
Correct.
Okay, here the asset itself is transferred, but it can be revocable at any point in time.
Correct. Yes.
Okay,
Absolutely.
okay, fine.
Fine. So let us write it over here. For your summarization only, I'm just putting it all the points together here. So 60 says transfer of income without the transfer of the asset. 61 talks about the revocable transfer. In both these cases, it will be clubbed in the income clubbed in the hands of transfer. Right? What is revocable transfer? 63 defines it where the transferor retains the power or the transferor has the transfer contains the provision for the transfer. Right? Now there is an exception to 61. What it says, exception where clubbing provisions are not attracted even in case of revocable transfer. What is it? 61 will not apply to any income arising to any person if there is a transfer by way of a trust which is not revocable during the lifetime of the beneficiary, and any other transfer which is not revocable during the lifetime of the transferee. So that means if it is an irrevocable transfer, if the transfer of the asset is irrevocable transfer, then in that particular case, clubbing will not get attracted. So this is an exception. Right? Now what it says is that any transfer by way of a trust. So where you incorporate a trust, right? Where you incorporate a trust, under a trust there are three parties. Under a trust, trust is not a person. Trust is basically where you're creating an agreement. In the trust, in the faith, in the good faith that this particular income will flow to particular set of beneficiaries. Right? This particular income will flow to the particular set of beneficiaries. So in that particular case, that is the concept of the trust. Okay, fine. So what are the three parties in the trust? Do you know that?
Trustee, beneficiary, and transfer. Who transfers
Yes,
the assets?
correct. So under the trust structure, so let's say this is the trust structure. The transferor is called the settler. He's not called the transferee or he's not called the transferor, he's called the settler, the one who settles the asset in the trust. The one who benefits out of the assets are the beneficiaries. And the one who manages the trust are the trustee. Fine. So when the settler settles the asset into the trust, and if he has the power over the income of the trust or the assets of the trust, which he can take back, it is what? A revocable transfer. But let's say, for example, if he cannot revoke the transfer of the assets back to him during the lifetime of beneficiary, it is a different matter if beneficiary dies and he will take back the asset. That's a different story. But during the lifetime of beneficiary, if he has no power to take back the assets, it is considered as irrevocable transfer. Are we clear? So that is an irrevocable trust. If it's an revocable trust, then in that case, the income will be taxable in the hands of the beneficiary, in the hands of the settler. Right? So if it's a revocable trust, income taxed in the hands of settler. If it is irrevocable, income taxed in hands of beneficiary. Is this concept clear, students, to everyone?
Yes, ma'am.
Yes. Second is where the transfer, not in the case of the trust, but generally any transfer which is not revocable during the lifetime of the transferee, in that particular case, it is considered as irrevocable transfer. In those cases, the income will not be included in the hands of the transferor, provided the transferor is not deriving any direct or indirect benefit from such income. If the transferor continues to derive the benefit from that income, directly or indirectly, it is not considered as irrevocable transfer. It will still be regarded as a revocable transfer and he will be taxed in respect of that income. Clear? Revocable, irrevocable, clear? This we are again going to look at the time of assessment of the trust structures. Fine. But that time I'll not spend that much time on revocable, irrevocable because we are already doing it over here. Any questions so far? Yes, 61 is clear. 60, 61, 62, 63, right? Fine. Let us proceed then further. Next is 64. Income of the other person now included in the individual's total income. First is clubbing of income arising to a spouse. 64.1.2. What does it say? That any remuneration from any entity, from any concern in which the individual has a substantial interest. So, let's say for example, remuneration to spouse from concern in which individual has substantial interest. Right? So let's say for example, this is ABC, a partnership firm. Right? Mr. A has a substantial interest. Now, what is the substantial interest over here? So it says circumstances when an individual is deemed to have a substantial interest in a concern. Where the concern is a company, if the individual has 20% or more, that is greater than equal to 20% of voting power of the shares. Right? If it is any other concern other than company, if the individual is entitled to greater than equal to 20% of the profit at any time during the previous year. So if he has a substantial interest here, which is profit sharing ratio, right? Share of profit more than 20% or greater than equal to 20% of voting rights in case of company. Now this firm pays salary to Mrs. A, right? This particular company pays the salary to, or this particular partnership firm pays salary to Mrs. A. Right? So in that particular case, this remuneration will be clubbed in the hands of the person. So this particular remuneration, this salary will get clubbed in the hands of Mr. A. Clear? Now he may not be directly owning 20% in company or in the partnership firm. He may be owning 20% jointly with his relatives. Still, it will be a substantial interest. So let's say, for example, if Mr. A doesn't hold more than 20%, Mr. A holds, let's say, 15%. Right? Plus, let's say, the father of Mr. A holds 5%. Still, it is a substantial interest. So, who is relative over here? Husband, wife, brother, sister, any lineal ascendant or descendant. So, spouses, the siblings, and the ascendant and descendant are relatives. So, even if he doesn't directly hold 20%, if he holds along with his relatives, it will still be clubbed. It will still be called as substantial interest. So in computing the total income of that individual, all the income which arises directly or indirectly to the spouse by way of salary, commission, fees, other form of remuneration, whether in cash or in kind, from that concern in which he has a substantial interest shall be included in his income. Are we clear? Yes or no?
Clear,
Yes.
ma'am.
Okay.
Yes, ma'am.
Now there is one exception. Okay. Keshav, I'll answer your doubt in a minute. There's one exception over here. The clubbing provisions will not be applicable where remuneration is received on account of the technical or professional qualification. So let's say, for example, let's say my husband holds a company and I am working over there and I am drawing some remuneration as a professional. Now he's having more than 20% share in a CA firm. Okay. And I am working there as a CA. And I'm drawing the remuneration because of my technical or professional expertise, not because I am just working there without any technical qualification. In that case, the clubbing will not be applicable. So, here it's an exception. If spouse has technical or professional qualification. In that case, the clubbing provisions are not attractive. So I can draw the salary if I'm working as a professional in that firm. Clear? Now, there is one more important point over here. What is that? So, it says that if both the husband and wife have a substantial interest in a concern and both are drawing the remuneration from the same firm, then how do you do clubbing? So, in that case, the spouse which is earning the higher income, the other person's income will get clubbed in that person's spouse. Are we clear? So just write it down over here. If both husband and wife have substantial interest in concern and both draw the remuneration. So let's say, for example, this is ABC partnership firm, right? Let's say Mr. A has greater than 20% profit sharing and Mrs. A also has greater than equal to 20% profit sharing, right? And both are drawing the salary. Right? Let's say Mr. A's other income is 10 lakh. Mrs. A's other income is 7 lakh. Right? So, let's say Mrs. A's income will be clubbed here in Mr. A. Mrs. A income will be getting clubbed here in Mr. A because his income is higher. Clear, students? Yes?
Yes, ma'am.
Fine. Now, there is one important linkage that I wish to draw over here, students. Right? Now, this linkage is with section 27. What is section 27? What is 27?
Ma'am, I have one query, ma'am.
Yes.
Ma'am, in this case, the both are substantially interested. Then that case, the higher of income will be clubbed. So
Yes.
suppose both are technically and professionally qualified while drawing the salary, then in that case, ma'am.
In that case, the clubbing provision will not get attracted. So then the exception applies. If both are drawing the income because of the technical qualification that they possess, then in that particular case, there's no problem. Clear?
Okay, ma'am.
Yes, Megha, 27 is related to income from house property, but what is it? Any idea? What is 27?
It has income from the house property has to be clubbed from the owner. जिसका प्रॉपर्टी ओन करता है उनके हैंड्स में जो भी इनकम आता है क्लब करना चाहिए.
Correct. So this is deemed owner concept. Right. There also we are reading one similar provision for the spouse. Okay. What does it say? An individual who transfers the house property to the spouse. Otherwise, then for the adequate consideration. Right? Meaning I'm not transferring out of like taking any consideration from spouse. I'm transferring for inadequate or for no consideration. I'm giving as a gift to my spouse. which is also not connected with any kind of, alimony, divorce related, right? Or I'm transferring it to my, basically, a minor child. We'll see about minor child later. This individual shall be deemed to be the owner of the house property so transferred. So where if the individual transfers the house to the spouse, right? Then in that particular case, the transferor will be considered to be the deemed owner. However, if it is any other asset other than house property, then in that particular case, what happens? If it is
And
any other asset,
clubbing
sorry,
of provisions will come. Clubbing of
correct,
provisions will attract.
correct. So for any other asset, you will see the clubbing, right? However, with respect to the house property, you will see that under section 27. So this is a difference between the two, right? So for house property, you will see under the IFHP 27. For the clubbing of income, for the other assets, you will go to the clubbing of income. And we'll see that now. Okay. So this is very, very important distinction that you should remember. House property you can't come under clubbing because there is already a specific provision prevailing over there. Clear? Now, in respect of this concern also, where the particular two people, husband and wife, are drawing the remuneration from the concern, both of them have substantial interest. In that particular case, if in 1 year, the Mrs. A income will get included in the income of Mr. A. In the next year, let's say Mrs. A has the higher income. So do we have to change his? Answer is no. In 1 year, what you opted, you can continue with that unless the AO is satisfied that it is necessary to shift it to the other person's income. So in 1 year, if I include it in the hands of Mr. A, Mrs. A income, in the next year, even if Mrs. A's income is higher, I will continue to include in Mr. A only. Clear? Any questions, any doubt? Fine. Let us look at these illustration. Mr. Arun holds the shares carrying 55% voting power in MNO Private Limited. Mrs. Anamika, wife of Arun, is working as a computer software programmer in MNO at a salary of 35,000. She is, however, not qualified for the job. The other income of Arun and Anamika are 7,30,000 and 4,20,000. Compute the gross total income of Arun and Anamika for the AY 25-26 if they are paying tax under the default tax regime. What would you do?
We will add the salary of Mrs. Anamika into the hands of Mr. Arun because
Yes.
she is not technically qualified.
Yes.
And mainly the substantial, the thing is that share is 20% of more in this case.
Yes.
55%, which means more than 20%.
Correct. So in this case, we will add the income in the hands of Arun. Anamika is not professionally qualified. Arun is having a substantial interest in MNO because it's more than 20%. But how much will you include in Arun's hand?
Only to the extent of salary alone. But the other income they are separately having, but it can be added to the respective heads.
Correct. In salary, what will be the income that will be added in the hands of Arun?
3,45,000.
35,000 per month into
4
Sorry?
35,000 into 12.
Yes.
plus standard
Minus you will
deduction
do
70.
standard deduction. Yes.
Yeah,
Minus the standard deduction, you will do all the allowances that the individual himself gets. When you club the income, the individual will be able to claim the same allowances.
yeah.
So you,
Default means
sorry,
75,000 standard deduction.
Correct. Yes, you will get the standard deduction of 75,000 over here. Clear? So this is how you will add the income. Don't forget to give the benefit of the standard deduction over here. So this is how you will add 4,20,000 minus 75,000 because it's a default tax regime. If it was not default, it would have been how much standard deduction?
50,000.
Correct, 50,000.
50,000.
Then it asks, will your answer be different if Mrs. Anamika was qualified? Obviously, yes. Because
Yes.
in that particular case, Anamika's income will not get clubbed in the hands of Arun. Clear?
Yes, ma'am.
Next is Binu holds shares 33% voting powers in Yama. Babita is working as an accountant in Yama, getting income under the head salary of 3,60,000 without any qualification in accountancy. Binu also receives 32,000 as interest on securities. Babita owns a house property which she has let out. Rent received from the tenant is 6,500. Compute the gross total income of Binu and Babita for the AY 25-26.
Ma'am, here also the substantial interest that 20% of more, here the 33%, then that the clubbing provision will apply when she is not qualified.
Correct.
In this case, she is not qualified without qualification. That the salary amount will be added. Accordingly, the standard deduction will be provided, and the house rent it will be ordered to that Mrs. Babita alone, and the standard deduction for the house 30% is allowed.
Correct. But here you will not allow the standard deduction. Why we will not allow the standard deduction over here?
It's already computed.
Yes, it says income under the salary computed. It is already computed for you. Had the word computed not given, then of course you should allow standard deduction. But you should read it carefully. It says computed. So this 360 will be added to the income of the Bino. Clear? Yes?
Right, ma'am.
Fine. Okay. Next is income arising to the spouse from an asset transferred without adequate consideration. What we were just now discussing. Which is now, see, we have done 64.12. Now we are moving to 64.14 and 27. Alright. So if the asset is transferred to spouse without adequate consideration, right? Without the adequate consideration. Now, if it is transfer of house property not in connection with agreement to live apart, then this particular transferor is the deemed owner, isn't it? And the GAV will be taxable under the head house property. However, if it is any other asset, then in that particular 64.14 will get triggered. So income clubbed in the hands of transfer.
Ma'am, 64.12 14 ma'am.
64.14. It's 64.14. Fine. So where there is a transfer of an asset directly or indirectly from one spouse to the other, otherwise then for adequate consideration or in connection with an agreement to live apart, any income arising to the transferee spouse from the transferred asset, either directly or indirectly, shall be included in the total income of the transferor spouse. That's a different matter if it is in connection with the agreement to live apart. which is basically in the case of the divorce, right? So here also this particular same thing will be applicable, not in connection with the agreement to live apart. Right? So that's a different story. Similarly, in the case of transfer of house property, the provisions are in section 27, wherein if an individual transfers the house without adequate consideration or otherwise then in connection with the agreement to live apart, the transferor shall be deemed to be the owner of the house property, and in that particular case, the income will be chargeable in the hands of the transferor. So if it's house property, you will go under 27. If it is any other asset, you will go under 64(1)(4). Right? Any question, any doubt so far?
Yes, does this transfer mean transfer in the name of the wife? In the name
Yes,
of the wife?
yes,
Transferred, okay. Registered
yes,
by registered deed.
yes. So the
So
moment
there
you
would be
transfer, not by registered deed also, if you, let's say for example, even if you don't register and tomorrow say that this is transferred in the name of the wife, you just make an agreement, you don't register it, still it is like you have an agreement. It's not like in some states it's not mandatory to register the agreements, right? So in that particular case, if you don't register, even when you have the agreement to transfer, that shall be considered as transfer. Fine?
Fine, but there would be no capital gain because it is a gift.
Yeah, there will not be any capital gain because it's a gift from the husband to the wife, because it is transferred for inadequate consideration or for zero consideration. There will not be any capital gain in that particular case. Nor there will be applicability of 56 to 10, because 56 to 10 becomes applicable for the cases other than the gift from relatives.
Relative,
Clear?
yes. Yeah, clear. Yes. Thank you.
Yeah. Now, what is the meaning of adequate consideration? Because it says transfer is not for adequate consideration. So, what is this adequate consideration? So, where the asset is transferred without adequate consideration, they are saying that income will be clubbed in the hands of transferor. Right? So, adequate consideration means the normal reasonable value which is there for that asset that you should get. If you're not getting that value, even when you transfer out of natural love and affection, it is not adequate consideration. It is still inadequate. Even if you transfer for, let's say, 15 rupees, 1,000 rupees, lakh rupees, that's an inadequate consideration. Clear? So where the transfer takes place without an adequate consideration, in that particular case, the income will be clubbed in the hands of the transferor. For any other asset, for the house property, it is under 27. I'm sorry. Clear? Okay. Now coming to the, let's write it. Okay, before we move further, I think let's write about this particular point about the capital gain as it was rightly pointed out. No capital gain in the hands of transferor, as well as no 56 to 10 in the hands of as gift to the relative. Clear? Now coming to the income from the accretion of the transferred asset. So let us say Mr. A gifted the fixed deposits to Mrs. A. Right? Or let's say he gifted shares to Mrs. A. Let's consider shares instead of fixed deposit. Right? So now whatever capital gain or dividend is there, this will be clubbed. Correct? However, let's say for example, this capital gain and dividend is reinvested by Mrs. A in the gold. And then she sells the gold. Will this capital gain be clubbed in the hands of Mr. A?
Oh, no, ma'am.
The answer to that is no. So any income from the accretion of the transferred asset is not to be clubbed with the income of the transferor. What you have to only club is the income from the transferred asset. So when you further invest and earn the income, not all the incomes are to be clubbed. So here, the first part of the transaction ends. If she reinvests this money in the FDs, earn the interest, or she invests in gold and sells the gold, this is not to be clubbed in the hands of Mr. A. So here the clubbing will not be applicable. So this is no clubbing on the accreted income. Clear? So whenever she will invest in the other asset and that other asset, when she invests her income into other asset and the other asset generates the income, that is not to be clubbed. Is this clear to everybody? Yes? Then what is where the assets transferred are invested into the business? So let's say for example, Mr. A gives the money to Mrs. A, right? And she invests this money into the business. And whatever the profits this business generate, the proportionate amount, right? The proportionate profit arising from such investment is to be included in the income of Mr. A. So where the assets transferred by an individual to a spouse are invested in the business, right? And the proportionate income arising to the transferee is to be included in the total income of the transferor. If the investment is in the nature of capital contribution, proportionate interest receivable by the transferee from the firm will be clubbed with the income of the transferor. So this profits share of Mrs. A will get clubbed with Mr. A. Are we clear? Now for this clubbing of income in respect of the business which is there. The clubbing of income with respect to the business which is there, in that particular case, you have to take into consideration the value of the investment as on the first day of the previous year, as compared to the total investment in the business by way of the capital contribution. So let us understand this by way of an example. So let's say Mr. Rahul started a proprietary business with a capital of 6 lakh. He incurred a loss of 3 lakh. To overcome the financial position, his wife Radha, a software engineer, gave a gift of 7 lakh to Rahul, which was immediately invested in the business by Mr. Rahul. He earned the profit of 5 lakh during the AY 24-25. Now, how much of this 5 lakh will be clubbed in the hands of the Radha? So, you have to see what is the capital as on 1/4/2024. What is the capital as on 1/4/2024?
Total 10 lakhs. 3 plus 7.
3 plus 3. No, 3 was a loss, right?
6 minus 3. 6 minus
Yes.
3, 3.
6 minus 3. It was a loss, right? So he had started with a capital of 6 lakh and he had incurred a loss of 3 lakh in the 23-24. As on 1/4/2024, he had a capital of 3 lakh. That was his own capital. What is the capital contribution he made with a gift of Radha? 7 lakh. Right? So total capital becomes how much?
10
10
lakh.
lakh. Correct? 10 lakh. Now, what is the amount of income which is to be clubbed in the hands of Radha? So 5 lakh is the total profit, out of which how much will you club in the hands of Radha?
In this case, 5 lakh into 7 divided by 10.
Correct. So 5 lakh into 7 is the capital given by Radha. Total capital is 10 lakh. So during the year, the total capital you have to see. How much was it? That's the reason why you have to determine the capital as on the 1/4/2024. So total income to be clubbed in the hands of Radha is 3,50,000. Are we clear? What if Radha gave a genuine loan to her husband? Because this is a common transaction between husband and wife. Now, if the income tax is going to club everything in my hands, let's say for example, if my husband is a founder of a startup, he needs money. Now, instead of borrowing the money from bank at a very high rate of interest, he would obviously borrow it from me. If I have the money at house, are we two separate people? Answer is no. Of course, in the eyes of income tax, we are. But as a family, we are a unit. If tomorrow I need money, I would ask for my parents. Right? Rather than taking the loan from the bank. Will now my income be clubbed in the hands of my parents, or my husband's income will get clubbed in my hands? The answer is no. If it is for the genuine business purpose, if it is for the bona fide purposes, then it will not get clubbed. But yes, if intention was to avoid the tax and you have given this money, then in that particular case, the income will get clubbed in the hands of the wife. Clear? Whether there will be 56 to 10, yes.
Ma'am, bona fide purposes कैसे defined? How one will identify it is for the avoidance of tax or for the bona fide purpose?
Yeah, that's a
By
good
seeing the
question.
transaction.
So you have to see what were the facts, right? Whether he really had no money. And let's say, for example, that's what I'm saying. Like if, my husband is now starting up a venture, a new business, and for which he is in the need of funds. Now, let's say in his bank account, there are 40-50 lakhs lying. And still, he's taking money from me. For the reason that, I am paying that, high income taxes any which ways. So I'm giving some money to him and he invests that in business. Right? So I'm transferring my asset to him. And that is only just to, shift my money. So that income will not, if I invest the money in the same startup, obviously I will be also taxable. Now I don't want to get taxed. So I'm giving money to him. You invest. Even though he has money. But where he genuinely did not have any money in his bank account. And that's the reason why he's asking his wife. Or I'm asking my husband. And that particular case, the income is for the transfer or the loan given is for the bona fide purposes. So you have to see based on the facts of each and every case. Right?
Okay, ma'am. And ma'am, then husband will pay the interest on the loan, right, ma'am? He has to
No,
pay
he
the
doesn't have
interest
to
to
pay
you.
interest
Then,
on the loan. If it is a bona fide loan, you can still give the interest-free loans.
okay.
Yeah?
Yeah.
Whether 56 to 10 will get attracted in the hands of Rahul, since he has received a sum
No,
of
ma'am.
money more than 50,000.
No,
No, ma'am.
received
Right?
from relative.
Correct. Received from relative. So whenever you are transferring any asset to relative, in the hands of the recipient, no 56 to 10. In the hands of the transferor, no capital gain. Are we clear? Any questions, any doubt? Yes? Fine? Okay. The next provision is transfer of assets for the benefit of the spouse. So what does it say? 64(1)(7). It says all income arising directly or indirectly to any person or association of person from the assets transferred directly or indirectly to any other person or association of person by an individual without adequate consideration, which is to be used by the recipient for the immediate or deferred benefit of the transferor spouse. So let us understand this. Let's say, for example, Mr. A transfers the, let's say, shares to a trust or to an HUF or to an AOP, right? So it says any person or AOP, right? From the assets transferred directly or indirectly, this is to be used. So the income from these assets is to be used for benefit of Mrs. A, either now or in future. Then this income will get clubbed in the hands of Mr. This will get clubbed in the hands of Mr. So when I'm transferring these shares or assets to any person or the AOP for the benefit of the spouse. So this income will get clubbed under 6417. Clear? Now let me take a few questions over here. I see some questions. If transfer of share with call option is revocable transfer. Keshav, transfer of share with the call option, like you are saying that I have again the purchase option in that case, or the call option that I have right to buy that asset back, right? That's what you mean. Yes, then in that particular case, it will be a revocable transfer. If house property is purchased, not transferred, originally in the name of one of the spouse, but consideration is paid by another spouse, then in whose income will rent will be included? Keshav, yeah, this is a very common instance where there are joint owners, because this is a very common thing all across, that whenever you purchase house, you purchase in the joint name of parents or in the name of the spouse. In that case, the income will be included in the hands of the person who has contributed for the house and not in the hands of the other person, right? If gift is made by Radha at 1/5/2023, in the question you are asking this question, this one, right? So instead of your gift is made on 1/5/2023, then what would be the answer? Fine. So in that case, we will see for 23/24. We will not see for 24/25. First thing, right? So because we are looking at the clubbing in the year in which the asset gets transferred. So as on 1/4/2023, you had a capital of 6 lakh, right? And she gave you the 7 lakh amount in the same year. So at the end of the year, your capital balance would have become how much? 13 lakh, right? Now 13 lakh and you incurred a loss in that year. So 3 lakh loss into 7 lakh divided by 13 lakh is the loss which Radha will get as the allowance to be carried forward and set off in the next year. Right? Because income includes the losses also. The government cannot just include the income, it has to even club the losses. Clear, Keshav?
Yes, ma'am.
Yes.
Ma'am, as on
Yes.
1st April 2023, since Radha has not given any capital contribution, so how the loss will be transferred to the Radha, ma'am? Because
As
we
on?
have, as on 1/4/2023, there is no capital contribution by the Radha, right? We have to see the first day of the previous year.
Right.
See, actually,
So there is no.
in that case,
So how?
assumed that the 6 lakhs is given by that Radha.
No, I'm not assuming like 6 lakh is given by the Radha. So what they are saying is it's not that, it has to be contributed on the first day. So if you look at the provision here, it says the proportion has to be computed by taking into account the value of the investment into the business as on the first day of the previous year to the total investment in the business or by way of capital contribution in the firm as the partner, as the case may be, by the transferee as on that day. So what they are trying to say is that as on the first day, if it is like, even if it is not contributed, right, on 1/5 it is contributed, but this is what is the provision applicable at any time during the year, right? So here the profit which is accruing to me is because of the investment that I am using it for the entire year, right? I have received this investment in the month of May, just 1 month less from 1st April. So I have to see as on 1st April what was the capital, because that capital, the income proportionate to that capital will not be clubbed in my hands. That will still be taxable in the other person's hand. Are we getting this point? So the balance amount which is there will be clubbed in my hands. So where the assets are transferred by an individual to the spouse and these are invested in any business, the investment which is in the nature of the contribution of a capital as a partner in a firm. So that interest which is receivable from the firm in any previous year, for the purpose of distributing it, I have to see the capital. What I have to see is that the proportion of the interest, how much it will be clubbed is the value of the investment which I have made divided by the total investment as on that particular date. Right? So during the year, my total investment is 13. As on the first day of the previous year, my investment was 6. So 7 is the investment still of Radha. So that will get clubbed in the hands of the Radha. Clear?
Yes.
Yes.
Clear, ma'am. Yes, ma'am.
Okay. Shall we move further in that case?
Yes, ma'am.
Yes, ma'am.
Yes. Now the next part of the is this particular clubbing provision is clubbing of income arising to the son's wife, which is basically your daughter-in-law, right? So what does it say? The same provisions as were there for your wife or the spouse are now there for the son's wife. So income arising to the daughter-in-law from the assets transferred without adequate consideration by the father-in-law or the mother-in-law. Now, asset is transferred without adequate consideration. Then in that particular case, the income from that asset is to be included in the total income of the transferor. Will there be capital gain in this case? In the hands of the transferor? Will there be capital gain? Yes. Gift to a daughter-in-law. Is there a capital gain on that? Yes, students?
No.
No,
No,
why?
ma'am.
Yes. Why no?
It will not be considered as a transfer as per definition of transfer.
Not definition of transfer. Under 47, under section 47, it says any transfer of a capital asset by an individual under a gift, it doesn't say gift to relative, it just says gift is not considered as transfer. So any transfer of a capital asset by an individual under a gift, there is no capital gain on that. Clear? It is not a transfer. Under 47. Right? Now what about 56 to 10? Whether in the hands of daughter-in-law 56 to 10 will be applicable? Yes, students, faster. Yes, I'm not getting answer. Not applicable. Why? Son, daughter not mentioned in relative definition? Yes. You have done EFOs, isn't it? Wife of ascendant is relative. Yes, that's right, Geet. So under 56 to 10, relative means if you receive the asset for inadequate consideration of a known consideration, it is not 56 to 10 is not applicable. What is a relative? Relative there includes the lineal ascendant of the spouse of the individual. These are the lineal ascendant of the husband. So in this case, this is not applicable. In exams, you will get questions like this, students. Yes or no? Are we clear? Yes? Okay? Yes. Now, in this case also, if the asset is transferred and is invested in the business, so where the assets are transferred by an individual, mother-in-law, father-in-law to their daughter-in-law, right? And she invests in the business. Let's say, for example, if I get the money from my parents-in-law and I invest in my CA firm, the proportionate income is to be included in the income of the mother-in-law, father-in-law. Right? So what they have to do is, again, same thing. You have to see the investment as on the first year of the previous year to the total investment and add that particular amount. Clear? Next is transfer of asset for the benefit of son's wife. Same thing. If my parents-in-law transfer the assets to the trust, AOP, BOI, right? Or any person, HUF, and these assets are to be used for my benefit without adequate consideration, then the income will be clubbed in their hands. Clear? However, again there, whether there will be capital gain, yes, whether there will be capital gain in that case,
No, ma'am.
because the assets are gifted,
Gifted.
right? So where, let's say for example, they transfer the assets to the trust, right? So here, no capital gain on gift. This is your section 47. Now these assets are to be used for benefit of the daughter-in-law. Okay, so in that particular case, here whether 56 to 10 applicable. Again, this is not applicable because receipt from the relative. Clear, students? Yes? So let us see this illustration. Mrs. Komal transferred the immovable property to a company subject to condition that out of the rental income, 42,000 per annum shall be utilized for her daughter-in-law. Mrs. Komal claimed that 42,000 utilized by her daughter-in-law should not be included in her total income as she no longer owned the property. Examine the reasons whether the contention is valid or not. What do you think? Is a contention valid?
No, ma'am.
Why?
No,
Because
ma'am.
it is utilized for the benefit of son's wife.
Yes. So if the transfer is for otherwise than for adequate consideration, 64,178 or 64,180 will get attracted and the income will be clapped in the hands of Mrs. Komal only. But if the transfer was for adequate consideration, then in that particular case, the 64,178 will not get attracted. Clear? Yes or no? Any doubt, any questions? Fine. Okay. Any questions so far? Any doubts? Shall we take a small break over here before we move further? Let's take a break of 10 minutes. Yeah. income of the minor. Fine. Clubbing of the minor's income. Now, all the income of the minor, right? Because he's a minor, you have to include it in the income of his parent. Unless he derives the income from either some manual work or through his skill, talent, or some specialized knowledge. These days, you see there are a lot of kids, participating in this Dance India Dance, or like there are different TV programs where they are participating as contestant and they may be winning some income. Or if you see it now these days on Instagram, there are many kids that who are participating in terms of they are earning from the brands, they are earning from different advertisement income. Now they are basically utilizing their own skill or talent. Okay, so in that case, this income will not be clubbed in the hands of parent. So only the income of the minor, which is not from some labor work, which is not with respect to specialized skill or talent, will get included in the hands of the parent. Now, what is the kind of income which gets usually included? Yes.
FD इंटरेस्ट बच्चे के
Correct.
नाम पे
FD,
करवाते हैं.
yes. FD interest, income, dividend from shares which are there.
Yes.
These will get included in the hands of the parent. Income from manual work, specialized skill, talent is not going to be included. What if a minor is suffering from a disability? So he would get a deduction under 80U, isn't it? He would get a deduction under 80U. So that
75,000.
deduction is also available to the parent. Are we clear?
Yes, ma'am. There is a 75,000 deduction.
Correct. So if the minor is disabled, the parent can claim the deduction under 80U. Are we clear? So this is how you have to read the provision to see that whether it is the skill, the income from some skill, or from the labor work, or it is the other income. So income of minor clubbed in the hands of parent. Right? Exception. Income from manual work or specialized skill. Okay, that is not included. If minor is disabled, deduction under section 80. Fine. Now the income of the minor will be clubbed in the hands of the parent whose total income is higher. And just like if you remember, in the case of the income of the spouse from a firm, right, will be clubbed in the hands of the spouse whose income is higher if both the spouses are drawing the remuneration and both were having the substantial interest. And in 1 year, if you add it to one spouse's income, in the next year, it will still be added in his, even if the other spouse income become higher than the first one's. Here also, the income of the minor will then every year on year get added in that parent only in the year in which you first added it, unless the AO is of the other opinion. And he feels that other person's income in the other parent's hand, it should be added. So, whose income is greater? And where the parents are divorced, then in that particular case, it will be added in the hands of the parent who is maintaining the minor. Any questions? Yes? Now, in respect of, since the minor's income get added in the hands of the parent, under 1032, the parent is entitled to exemption of 1500 rupees. So there is exemption under 1032 of 1500. Is this exemption available under the 115 BAC scheme?
No.
No, ma'am.
So when
This
you
is
are
not
opting out, it is available.
correct. So this particular exemption is not available in the 115 BAC. So this is not applicable under section 115 BAC. Clear? So under 115 BAC, you will not get. If you opt out, you can still get. Now, again, we are going to draw a distinction over here between 27 and the 64. Right? So under 27, what did we discuss? The person who transfers the house property to his spouse, otherwise than for adequate consideration, he shall be deemed to be the owner of the house. Now, if the individual also transfers the property to a minor child, if he transfers the property to a minor child, he shall be deemed to be the owner of the house if the transfer is otherwise than for the inadequate consideration. Are we getting this particular point? So, under 27, transfer of house to minor, right? Here, this is covered under 27. If it is transferred to a minor son or to a minor unmarried daughter, then the transferor is deemed to be the owner and the GAV clubbed in the hands of, or GAV not club, GAV chargeable in hands of transferor. Fine. Now, if he transfers this to unmarried instead of minor married daughter, or he transfers other asset, right, to a minor, including minor married daughter, then in that particular case, there will be clubbing of income under 64(1)(a). And if he transfers the house to minor married daughter, here 27 is not applicable, but 64(1)(a) is applicable. So if you read here, it says the same thing. In case the asset is transferred to a minor child, not being a minor married daughter, without consideration or for inadequate consideration is a house property, then 27(1) says the transferor parent will be deemed owner of the house. So it covers only minor son and minor unmarried daughter. So income from house property will be taxable in the hands of the transferor parent, who is the deemed owner, and not in the hands of minor child. However, in the case of the minor married daughter, if he transfers the house, then in that particular case, the 27(1) is not applicable. It is 64(1)(a) which becomes applicable. Are we getting this? So under 27, we only have minor son and minor unmarried daughter. To that, 64 doesn't apply. But if the property is transferred to the minor married daughter, then 27 is not applicable, 64(1)(a) is applicable, and the income will be clubbed in the hands of the parent whose total income is higher, and they'll be eligible to claim even benefit under 1032 if they are opting out of 115 BAC. And mind it, here the child or the minor includes a stepchild or an adopted child as well. Clear, students? Any doubt?
Oh, no, madam. How many, up to how many child is allowed, madam?
No restriction.
Okay.
Let us look at this illustration. Arvind has 3 minor children, 2 twin daughters aged 12 years and 1 son aged 16. Income of twin daughter is 2,500 and son is 1,200. Avani has transferred a flat to the minor son out of natural love and affection. Flat was let out on the same date and rental income is 10,000 per month. Compute the income in respect of minor children to be included in the hands of Arvind and Avani, assuming that Arvind's income is higher than Avani's. Before including the income of minor children, and both Arvind and Avani exercise the option of shifting out of 115 BAC. How would you calculate? Yes.
Twin daughters 2,500, 2,500. It will be added in the hands of Mr. Arvind because he is having more income than Mrs. Savani. Those twin daughters' income will be added since they have opted out of the default regime 115 BAC. Under section 1032, 1,500 will be available in case of 2 twin daughters. And for the son, it is 1,200. So it will, after the assumption, it will be not taxable 0. It will be not not in the hands of the Mr. Arvind.
Correct. So this 1,500 is per minor child. Right? 1,500 is per minor child that you will get. So you will not get the refund of the income. So what you will do is, so 2,500 into 2, which comes to 5,000. Exempt is 1,500 into 2, 3,000. So 2,000 you will add it to the income of Arvind. Are we clear? So 2,000 will be added. What about the house property?
It will be taxable in the hands of Mrs. Savani.
In the hands of Avani, because she will be deemed owner. Even if you transfer the house out of natural love and affection, that is not the adequate
Because Mrs.
consideration.
Savani has.
Yeah. Yes. Yeah. So here the rental income 1,20,000, 10,000 into 12 months. This will be added in the hands of Avani, and if you look at it, 30% standard deduction will be allowed. So don't forget to claim the standard deduction of 30%. 84,000 is the income which will be taxable as a deemed owner of the house in the hands of Avani. She will not get exemption under 1032 because the clubbing under 64(1)(a) is not applicable. Right? Is this question clear, students? Yes? Fine? Okay.
Yes,
Now
ma'am.
coming to the cross transfer. Now what is this cross transfer? Understand this thing. Cross transfer basically happens, let's say for example, A is giving a gift. Let's say we will write it over here. Let's say A gives the gift to the, let's say, wife of his brother. Let's say A and X are brothers. So he is giving to Mrs. X, right? His sister-in-law. Right? Now A is giving the gift to the wife of the brother. He's not giving the gift to his brother. For the purchase of a house by her. So with this gift, she will purchase the house. And the X, Mr. X, gives the gift to the son of A. So A is giving the gift to the sister-in-law, who is Mrs. X, for the purchase of house, and B is giving not back to A but A's son of shares in a foreign company, let's say. Both the amounts are rupees 50,000. This is also rupees 50,000. Now he is a minor. So what does this provision say? The income from the assets transferred would be assessed in the hands of the transferor if the transfers are connected in such a way that they form a single transaction. So what was happening here is, if B gives the amount to wife, what will happen? In the hands of B, there would have been clubbing. If A gives the amount to the son, minor son, what would happen? Income would have been clubbed in the hands of A. So in order to avoid the clubbing, what are they doing is, A is giving gift to the wife of B and B is giving the same amount back to the son of A. In that particular case, this transfer is intimately connected. This transfer is such a way intimately connected that it forms part of the single transfer. And each transfer constitutes the consideration for the other. Each transfer constitutes the consideration for the other by being mutual or otherwise. So the transfers have been made by A to actually his son and B to actually his wife. Right? This was only done in this indirect way to circumvent the provisions of the clubbing. So Supreme Court in Kesavji Morarji had observed that if the two transactions are intimately connected, are so interconnected that they form part of the same transaction and it actually is a consideration for one another. And this is just a circuitous method adopted to evade the tax. So the income arising to Mrs. B from the house property shall be included in the income of Mr. B. So this is the case of cross transfer. So this income will be clubbed here and this income will be clubbed here. Are we clear? Yes, is this understood? Yes or no, students? Is this
Ma'am,
understood? Yeah.
what happens if both are not the same amount? If it is some 50,000 and some 70,000 like that. One is giving 50,000 and other is giving 70,000.
See, in that particular case, also, if you look at it, you may say that the amounts are different, right? So, in that particular case, one may say that this is the different amount and it is not actually a consideration for one another. But if you look at the transaction, is just to circumvent. You have to see what was the intention. Like, why would somebody give to the sister-in-law? Was it out of the gift? Was it like back to back? Was it after some point of time? So you have to look into those facts. If you feel that, this was not in a way that one is trying to circumvent the clubbing provision, it's fine. But if it appears that this was done to circumvent the clubbing provisions, this was a back-to-back arrangement, then in that case it will apply. So it is based on the intention. See, cross transfers are not coming out of the act. It is based on this case law wherein the tax evasion was observed. If there's no tax evasion which is observed based on the facts, this is not applicable. This is not something which is a mandate coming from the act itself. Are we getting that?
Yes, ma'am. Okay, ma'am.
Okay. Let us look at this illustration. Madan gifted a sum of 6.5 lakh to brother's wife. On 12th July, his brother gifted 5.2 lakh. Now, if you see here, the amounts are different. So, Madan has gifted to sister-in-law on 14 June. On 12th July next month, his brother gifted him 5.2 to the wife of Madan. The gift amounts were invested as FDs in the banks by Mrs. Madan and the wife of Mr. Madan's brother at 9% interest on 1st August. What will be the consequences over here? So, the Madan has gifted to his sister-in-law. And in the next month itself, his brother has gifted 5.2. And these amounts were invested in the fixed deposit by both of them. So, it appears that these are cross transfers. Even if the amounts are not exactly the same. However, the two transactions seems to be interconnected to avoid the tax. So the interest on these fixed deposits would be included in the total income of Madan on 5.2 and in the hands of the brother of Madan to the extent of 6.5. Are we clear? Yes or no? Yes. Any questions? Any doubt? Yes or no? Is this understood? Yes. So here if you look at it, in the hands of the Madan's brother's wife, basically Madan's sister-in-law, entire interest on 6.5 will not get added because cross transfer is only to the extent of 5.2 lakh, the same amount which is there. Over and above, he has paid the excess amount. So only to the extent of 5.2 lakh interest in both the brothers' income will get clubbed. Not to the extent of 6.5. Are we clear? Yes or no? Is this understood well?
Yes, ma'am.
Fine.
Yes,
So
ma'am.
is clubbing provision clear to everybody? Yes or no? There is no section for cross transfer, but only a Supreme Court judgment. Yes, Keshav, that's right. Okay. Let us look at the last provision, which is the conversion of self-acquired property into the property of HUF. So 64(2) is particularly the provision in respect to that. It says where an individual who is a member of HUF converts his individual property into the property of HUF, of which he is a member, then the income from such property will continue to be clubbed in the hands of the individual. If he transfers otherwise, then for adequate consideration. Now tell me one thing, will it be a capital gain here in the hands of the member? Will there be a capital gain under 45?
No.
Why no capital gain?
It's a transfer under section 47.
So under 47, it says transfer of a capital asset by an individual, right? Or an HUF under a gift is not regarded as transfer. So if it is in transfer by an individual to an HUF under a gift, then there will not be any capital gain. What about the 56:10 in the hands of the HUF? Yes.
No, ma'am, because it is received from the member, right?
Right.
So it
So
will
in
not
case
be
of
taxed.
correct, in case of HUF, if you receive from any member, 56:10 is not applicable on that HUF. Clear? So here no 45 because of 47 and no 56:10 will be applicable in this case. Secondly, it says where the converted property is now getting partitioned because of either total or partial partition. The income derived from such converted property as is received by the spouse on the partition will be deemed to arise to the spouse from the assets transferred indirectly by the individual to the spouse and shall be included in the total income of the individual who effected the conversion of such property. Now, once this property has been transferred into HUF, and let's say this HUF gets partitioned. Now, the spouse of that individual also gets some share in the property or the income from that property. Now, this will be arising to that spouse, but it will be deemed that this income is arising to the spouse from the assets transferred by the husband. And there will be clubbing of income in the hands of the husband. Whether when the HUF distributes the property during the partition, is there any capital gain?
No, ma'am.
No, because 47 says any distribution on the total or partial partition, there is no capital gain. Clear? And once this income is included in the hands of that individual, it will not again be included in the hands of the HUF. Yes, so this was a very small point which I thought we'll cover. Any questions, any doubt? Yes, so this completes your clubbing of income provision. Any questions that you have before we close the chapter?
मैम
Yes,
प्रैक्टिकली कुछ लोग एचयूएफ पे बिजनेस भी करते हैं, राइट मैम?
correct.
तो एक्चुअली एचयूएफ को कैपिटल कैसे जनरेट होगा? क्योंकि अभी जब सपोज मेंबर ने कुछ पैसे ट्रांसफर किया एचयूएफ पे, तो क्लबिंग ऑफ प्रोविजन ऐड होके जो इनकम कमाएगा फिर इट विल बी एडेड टू द हैंड्स ऑफ द मेंबर, राइट?
Correct.
तो एचयूएफ वहाँ करने का मतलब कैसे होगा? वो फिर इनकम टैक्स में इनकम एचयूएफ में कैसे जाएगा?
See, if you transfer a property to the HUF, then in that particular case, it will be clubbed in the hands of the individual. However, you can transfer the money into the HUF and let the HUF purchase the property out of it. If you transfer a capital asset like, house property, if you transfer like, some kind of shares into the HUF, then this will be clubbed in the hands of the transferor. But if you transfer the money and then HUF buys from that money, then there is no problem.
तो
Because then
मतलब we
it's not
can
a transfer of property.
we can transfer money to the HUF.
Correct. You can transfer the money to the HUF.
Okay.
Ma'am, I have doubt.
Yes.
Ma'am, my son is 18 years or more, and I have gift how many rupees or cash or check? With any limits?
No limits as
No.
such. Yeah.
I can give any amount to my son account. Bank
Yes,
account.
you can. Yes.
And if income from such money, I have clubbing provision is not applicable. Na?
Yes. If it's a adult, it is not. If it is, so for if he's a minor, then in that particular case the income will be clubbed. But if he's a major, then in that particular case the income will not be clubbed.
Okay,
But
thank
ma'am,
you.
however, the source of income, the income tax may ask, where is the source of income? See,
Yeah, see, they can make the additions on the basis of unexplained investment. Why, like you are not able to explain the source, cash credits like that. But certainly you can, like, if you are able to explain the source of this income, then there is no problem as such. Like you can gift, there is no limit on the gift per se. What is the problem is that, see, when a person receives any credit, right? So 68 is the section which gets triggered. Now, what does 68 say? 68 says that you have to explain what was your source of income. Otherwise, it will be considered as unexplained cash credit or unexplained investment. So, where any sum is found credited in the books of accounts, right? And you're not able to offer any explanation. If you can say the source was the gift from my father and the A was satisfied, then it's fine. However, the person who has given you the money, now your father, also needs to offer an explanation about the nature and the source. From where did he get the money? Right? So you have to not only offer, like you have to offer, but even your father should be able to, source should also be explained. Are we clear? Clear?
Yes, ma'am. I have 50 lakh shares. Now I'm sold 25 lakh shares and such amount transfer to my son account. And then my son demat account purchase new shares. So no problem. Na. This is a genuine transaction. Na. As a
Yes.
gift. 25 lakhs is a gift.
Yeah. So if your
So
son
I
is
can.
major, there is no problem.
Okay, ma'am. I have divided long-term capital account 1.2 to 25 lakhs exemption limit get
Correct.
benefit to
See,
limit.
why this was, like if you see these two provisions, 64 is mainly towards three parties. One is minor, because any which ways minor can't have his own income. So how would you assess? Like earlier, it was not even possible for minors to get the PAN. So how would they file the returns? So that's the reason why, they said that it will be clubbed in the hands of parent unless he is exercising some kind of skill or something. Other 64 sections, if you see, are applicable in case of two people. One is your spouse, second is your daughter-in-law. Now, why this was introduced? Earlier, the women were not that much working, right? So people used to really transfer the money in their accounts because they were not, working. They were majorly housewives, not having their own income. So people were transferring. So this was a scheme deployed by many people, and the income tax department thought that this is a scheme which is being deployed to avoid the taxes, and this was a specific anti-avoidance rule introduced, right? Now, if your son is a major son, obviously the presumption of the department is that he would be having his own income, so you would not be actually avoiding the tax because beyond 18, one can usually generate their income, right? So that is the reason why this was only created for the daughter-in-laws and the wives or the spouse for that matter. Obviously, they didn't say wife, they just said the spouse. But these days, these provisions are still relevant where, the other party does not have that much income, but where the other party has the income, these provisions are not really useful in a way, unless, it is a case seen for the tax avoidance again.
Okay, thank you.
Yeah. So now we are still left with 45 minutes. We're not stopping early. We'll go to the next chapter, which is,
Will
yes.
you discuss section 65 also?
See,
There's
65 is again, it's very simple provision. I mean, I didn't intend to discuss that much because it's just saying liability of the person in respect of the income included in the income of another person. So basically what it says is that because of 27(1), which is the deemed owner, the income is basically included in the total income of the assessee, right? So the person in whose name the asset stands, where you have transferred the asset, or who is a member of the partnership firm, where the income is from any membership in the firm. So basically, income is transferred in relation to that investment in business and all of that. Then the notice of demand shall be served on whom? On the income, on the person in whose hands the income is getting clubbed, or in the hands of the person in whose name the asset stands. So it says the notice of demand shall be served by the AO, and the liability to pay the tax on the income which is included shall be on the assessee who has, like, in whose books we have clubbed the income. Not in the hands of the person to whom asset is transferred, because the income is getting clubbed in a person's hand. So he will be liable for the payment of demand. Are we clear? So this is what section 65 particularly says. So it's a very, procedural section, not something to do with the taxability of income. Now let us move further in respect of the next particular topic. Yes.
Ma'am, I have a query. Ma'am, abhi, if we can create a HUF and we transfer, since money transferred to the HUF is not clubbed, तो HUF में ट्रांसफर करके वहाँ पे FD करवा सकते हैं ना मैम?
Yeah, we can do that. See, HUF में आप कुछ भी कर सकते हो, आप money डालो, then you can do the business there, you can buy the shares there, you can do anything in the HUF.
Okay.
Yeah. Okay. Let us start with the next topic, which is the set off and carry forward of the losses. Right? Let me just share the screen. Let me know if the screen is visible.
Visible, ma'am.
Yeah. Okay. Okay. So first is section 70 of the Income Tax Act. What does it say? First, you have to set off the losses within the same head of income from one source with the another source. Loss from one source with the another source. So inter-source set off of loss under the same head of income. For example, if we can't have losses under salary, right? Nobody makes losses under salary. If you have house property loss, if you have rental income from another house property, set off first against that. If you have loss from the business or profession, set off first against the other business profit that you may have. I may have two businesses, one manufacturing, one retail. I may have incurred loss in retail, profit in manufacturing, set it off. However, if I have a specified business loss, can I set it off against normal income?
No, ma'am.
No, we can't. Specified business loss, we can only set it off against the specified business income. Similarly, speculative business loss, it's a business. Can I set it off against normal business?
Oh, ma'am.
You have to set it off against the same speculative business. So there are certain exceptions to this rule. If you have loss from the capital gains, short-term capital loss can be adjusted against long-term capital gain. But long-term capital loss, can you adjust against short-term?
No, ma'am.
We can't. Long-term capital loss can only be adjusted against the long-term capital gain. If you have loss under other sources, you can set off against any source. But if you have loss from the maintaining and activity of owning and maintaining the horses, you cannot set off against any income. So under 70 tells you first you set off inter head. Sorry, intra-head, not interhead, intra-head. The exceptions to this are the speculative loss, specified business loss, LTCL, horse winning. Fine. Then it says if the loss still remains. Then it says if the loss is not set off within the same head, then you go to the other head. Then you can set off against the other head. And that's what we are going to look at it. That's what 71 talks about. And then if you can't set off interhead also, carry it forward in the future years. Carry it forward in the future year for the time limits which are given. Clear? Any questions? Now, this particular note is given which is saying that under the concessional tax regime, 115 BAA, 115 BAB, 22-15%, 115 BAC for individuals, 115 BAD for the cooperative society, again 22, 115 BAE for cooperative society, 15. There are certain brought forward losses or the unabsorbed depreciation which is not allowed under these concessional tax regime. What are not allowed? Brought forward specified business loss, because you don't get the deduction of the specified business under 35AD under concessional tax regime. So you will obviously not be allowed the claim of the brought forward business losses also. Yes or no? Brought forward business loss on account of the scientific research expenses which are for the outsiders. 3512, 3512A, 3513, 352AA. Remember what are these? Contribution for the scientific research to another company, contribution for social science research to another company or laboratories, right? Right? Contribution for the statistical research, right? Contribution to the national laboratory or IIT. These are not allowed as the deduction, and if any brought forward loss pertains to these deduction, these will not be allowed under the concessional tax regime. Unabsorbed depreciation. With respect to the additional depreciation is not allowed to you as a deduction. So unabsorbed depreciation will also not be allowed to you as a deduction. Yes or no? Any questions, any doubt? Yes? Is this understood?
Yes.
Fine. So this is because
मैम
that, yes, please go ahead.
अभी सैलरी इनकम है मैम, और हाउस प्रॉपर्टी में लॉस है, तो फर्स्ट ईयर ही ऑप्टेड आउट ऑफ 115 BAC, सेल्फ ऑक्यूपाइड है, तो वहाँ पे लॉस आया, तो ओल्ड रेजिम में है तो उसमें लॉस सेट ऑफ करेंगे, अलाउड है। अगर नेक्स्ट ईयर उसने क्या किया, न्यू स्कीम में गया, तो न्यू स्कीम में सेल्फ ऑक्यूपाइड है, तो वहाँ पे लॉस अलाउड नहीं है, राइट? तो वो अलाउ नहीं करेगा। सपोज नेक्स्ट ईयर में फिर से वो ओल्ड में गया, तो वो जो कैरी फॉरवर्ड लॉस अलाउड रहेगा या फिर नहीं रहेगा मैम? क्योंकि सैलरी में तो अपन जा सकते हैं ना मैम, ओल्ड न्यू में रेस्ट्रिक्शन नहीं है।
Correct. Next year you can claim. See,
अगर
unless you
ब्रॉड
yes,
फॉरवर्ड, मेरा क्वेश्चन है, ब्रॉड फॉरवर्ड जो लॉसेस है वो कैरी फॉरवर्ड होगा थर्ड ईयर में, या फिर सेकंड ईयर में अपन न्यू
carry
रेजिम में
forward
चले
होगा.
गए तो?
Correct. So if you read even here, what it says is in case of person covered under 115 BAC, when you are not opting out of 115 BAC, the loss from the house property, which is from the self-occupied property, cannot be set off against under any other head. Are we clear? So if you are, let's say for example, not claiming, if you are having the loss from the house property, now you are not able to set off against any other head. whatever brought forward loss from the self-occupied house property is there. Now, this is not eligible to be allowed while basically calculating against any other income. So, any rental house property loss which is there, that you can, so the interest on the rent you can claim, but any loss from the house property you cannot set off against any other income. Now, when you're not able to set off, right?
Ma'am,
Yes.
one thing, that loss from house property you can set up against the salary income, right?
Loss from the house property. Sorry, I didn't
Loss
get
from
the question.
loss from the house property can be set up against the salary income.
Yes. You're talking about
It is only
115
up.
BAC or without 115 BAC?
It is only up to the extent of 2 lakhs. It can be set off from the salary, and if it is more
Yes.
than that, it will be carried forward if you out of 115B.
Correct. But see, under 115 BAC, what it says is that when you compute the 115 BAC, you have to calculate without any set off of the loss under the head income from house property. So you will not be able to calculate any loss under the head house property against any other income. Are we getting it? So there are two things. One is for the self-occupied property, you cannot claim the loss. Self-occupied property, you cannot claim the interest deduction because that is what it says, 24(2) deduction is not allowed. However, for the loss in respect of even the rental property, that will also not be allowed to you to set off against any other head under the 115 BAC. If I open and show you the 115 BAC, let me show you that. Let us look at the language. Sorry, I was saying 24. What does it say? It says, for the purposes of 1A, the total income shall be computed without any deduction of clause B of 24. What is 24B? Interest. Interest on loan. In respect of the property referred to in 23.2. What is the property referred in 23.2? What is the property referred in 23.2? SOP.
Self-occupied property.
Correct? So you will not get any interest deduction for the loan with respect to SOP. Right? So any which ways that means what? For SOP you cannot take any loss. Correct? Then that means for LOP, TLOP, you can take the loss. You can take the interest deduction. Not loss, you can take the interest deduction. Correct? For LOP, for DLOP, you can take the interest deduction. Yes or no?
Yes, ma'am.
Then it says without set off of any loss. Under the head income from house property with any other head of income. So even in case of rental house property, if you have loss, you cannot set off against any other head of income. And that's what even this provision here is written. So if you are a person covered under 115 BAC, the loss from the house property cannot be set off against the any other head. It can be rental, it can be SOP property. Are we clear? And the brought forward losses from the SOP are also not allowed to be set off while computing the total income over here. Is this clear, students? Yes or no?
Clear, ma'am.
Fine. So here, that's the thing that they are telling you. That you cannot set off certain losses for which the deductions are not allowed to you. And for which the deductions, if it is not allowed, the losses attributable to those deductions will also not be allowed to you. Fine. Any questions, any doubts so far? Okay? Okay, let us move further then. Now coming to the first provision, the inter-source set-off of losses. This we discussed. We discussed about what are impermissible long-term capital loss, speculation, activity of owning and maintaining specified business. Loss from the exempt source also cannot be set off against the profit from a taxable source of income. For example, if you are claiming the partnership profit as exempt, the partnership losses you cannot claim. Because if the income is exempt, then the losses are also exempt. Yes or no? Now next comes the inter-head adjustment under 71. First we talk about income from house property. Can you set off the loss from the house property against the other head of income? So,
Yes, ma'am.
I'm writing as salary, house property, PGBP, capital gain, income from other sources. And these are losses under the head first IFHP. How much you can set off against the IFHP? So where the result of the IFHP is a loss and you're not able to set off against the same head, then what you can set off is only up to rupees.
2 lakhs.
Can we set off against all the income? Answer is yes. So the maximum loss from the house property which can be set off against any other head is 2 lakh. However, if you are not opting out of 115 BAC, if you are not opting out of the 115 BAC and there is a loss under the head house property, then will you be allowed the loss?
No, ma'am.
Will not be allowed the loss. Are we clear? So just write it over here. No house property loss allowed under section 115 BAC. Clear? Next is loss from normal PGBP. Can you set off against salary?
No, ma'am.
We cannot set off against the salary, right? Can we set off against the house property?
Yes.
Yes. You can, of course, it's interhead capital gain.
Yes.
No.
Yes. Yes. Capital gain.
Yes.
Yes. We can set off. EFOS. Yes. Now loss from speculative business. Can you set off against salary?
No, ma'am.
House property?
No.
No.
PGBP?
Only speculative business, normal business.
Only
No.
against speculative business income. No capital gain, no EFOS. Same is loss from specified business. Right? Only against correct? Is this clear? Yes or no?
Clear, ma'am.
Fine. This loss from normal PGBP can be set off against all business. Right? Including speculative and specified business. Normal business losses can be set off against the specified business and speculative, but speculative cannot be set off against that. Clear?
Yes.
Short-term capital loss. Salary, can you set off?
No, ma'am.
No. House property, can you set off?
No, ma'am.
Yes or no?
No.
We cannot. Okay. So capital losses can only be set off against
Capital loss. Yes, sir.
capital gain. It can be short-term, it can be long-term. Right? And LTCL can only be set off against
Long-term
LTCL.
capital gain.
Right? It can be only set off against the capital gain. Clear? Any questions? Any doubt? Yes. Okay. Now the carry forward. So if still the losses remain, right? If the still losses are remaining. Now first about the house property loss. And where you have opted out of 115 BAC, because if you're going under 115 BAC, you did not have any loss at the first place because you were not allowed. If you're opting out of the 115 BAC over and above 2 lakh, this will be carried forward and set off in the future years against the income under the head.
House property.
Now next year, if let's say for example, this year I opted out, I have the loss. Now this is not against the self-occupied property. This is pertaining to the rental property. And next year I have income under the head house property. Can I set off in the next year against the income under the head house property if I go for 115 BAC?
Yes, ma'am. It is allowed.
It is allowed. So if you look at it, it says the loss under the head income from house property, this is the current year loss, cannot be set off with any other head of income. Right? So you can set off only the current year losses against the other head of income. The losses that you carry forward in the next year, you cannot set off against any other head for all the losses. You can only set off against the same head. In the current year, first you do the intra head, then you do the inter head, and then whatever remains you will carry forward. And in the next year, the brought forward losses you can only set off against the same head. So 115 BAC says that you cannot set off the current year losses of the house property against any other head. But the brought forward losses, you can set off against the income from house property. But you cannot set off the SOP loss. Why? It says without the set off of any loss carried forward from any earlier assessment year, if such loss is attributable to any of the deductions referred to in clause 1. And clause 1's refer interest on SOP property. So if the loss pertains to the SOP property, a brought forward loss, that will not be allowed to be set off against the current year house property income. But it can be set off against the rental loss can be set off against the house property income. So just write it over here. SOP loss, if you are going under 115 BAC, not allowed to be set off against current year house property income. Right? Brought forward SOP loss, also not allowed. against current year house property income. This is current year loss. Okay. Rental property, current year loss not allowed against any income. However, the brought forward losses allowed against IFH. Is this clear, students?
Clear, ma'am.
This is the same. Clear? Fine. So you can carry forward this particular loss for how many years? 8 assessment years. So in the next year, you will allow only against the house property income. Are we clear?
Clear, ma'am.
Yes. For the, this is, remember, only for the individual. Right? This is for individual. If
Ma'am, I have a
the,
doubt.
yes,
Ma'am, I have interest on housing loan 3 lakhs,
yes.
self-occupied property. So
Ah.
allowed is up to 2 lakh.
Hmm.
So 1 lakh is left or carry forward.
Carry forward. If it is normal tax regime, if it is 115 BAC regime, lapse.
Okay.
So let's say, for example, let us take an example. Here I have, let's say, 3 lakh SOP loss. This will entirely lapse. No set off allowed. If there is 3 lakh rental property loss, this again lapse, right? Let's say I have 2 lakh, let's say, rental income, right? So 1 lakh lapse. Fine. If I have,
Ma'am,
let's
why?
say, sorry,
Ma'am, it is let out property, right, ma'am?
correct?
So for let out property, it can be carry forwarded, right, ma'am?
No, here I'm not claiming only, na. This 1 lakh, see, what they are saying is your current year losses which are there, you cannot set off against any other income.
He
And
cannot.
this should completely lapse because you're not able to set it off. You cannot even carry it forward to the next assessment year. So that's what, we saw this under the first chart itself. If you look at this particular chart, what it says, loss from the house property cannot be set off against and cannot be carried forward.
Yes,
Because,
madam.
yeah,
Yes, ma'am. Under 1 BAC, it cannot be carry forward.
correct.
Even
Only
if it is rental loss.
only that particular year, on the first year, even under 1 BAC, can be set up against only income against the house property alone, not for other.
Correct. That too only if it's a rental. If it is not rental, if it is house SOP, it lapse.
SOP it is not allowed. Yes, right.
So even when I have the 2 lakh, let's say your rental income, this 3 lakh will lapse. Here, if I have 3 lakh, this having 1 lakh will lapse.
Yeah, only the benefit is there when he when we shifting out of the default scheme, then 2 lakhs are to other heads of income, then can be forward for 8 assessment year only set up against the income from house property.
Correct. Okay. Now, let us look at this question. We will understand it more in detail. Income from salary. Yes.
Yeah, but speculative business loss can be followed for 4 years only, no?
Yeah, we'll see that. For the speculative business, we have not yet come. First, we'll see for house property and then we'll move to speculative also. Income from salary 420, income from let out 230, loss, business loss 120, and bank interest FD 50. First is opted out of opted out of 115 BAC. Second, he has gone as per 115 BAC. Now, if you look at this 420, right? So this 420 is the income from salary. Now, loss from the let out property 230. So first is we have opted out of 115 BAC. What would you do to 230?
The
Two,
2 lakh,
2 lakhs will set off.
Correct.
the
2
we
lakh
can
will be set off against 420. Balance
salary.
30,000.
Balance 30,000 we can carry forward to next year.
Correct. Balance 30,000 you can carry it forward to the next year. Or you can set off against the bank interest FD also. Right? You can set it off against the bank interest FD also. Oh, sorry, no, we can't because the limit is 2 lakh. So
No.
30,000.
See, the 2,30,000 is there. Already we used the 2 lakh limit.
Correct. We use the 2 lakh limit, so 30,000 will carry it forward. What about the business loss of 120?
That can be adjusted against business bank interest, other
Correct.
sources.
Yes, balance 35,000 will be carried forward to the next assessment year. Fine. So this is how your loss set off will work if you will opt out of the default tax regime. Alright. Now, as far as if you go under the default tax regime, what would you do?
Ma'am, that 2,30,000 we cannot set up against any other income. We cannot carry forward also.
Correct. So this 230 will lapse. And what about the business loss?
That can be adjusted against bank interest.
Correct.
Balance can carry forward.
Correct. Yes. So now we are clear about the set off of the house property loss. Fine. Okay.
Yes, ma'am.
Fine. Next is the set off and carry forward of the business losses. Right. Now under 72, the condition is that the loss should have been incurred in the business or profession or vocation. It should not be a speculation or specified business loss. Then you can set off from one business against any other business. It can be speculative business. It can be specified business. It can be anything. But then once it is still remaining, even when you set it off against the business income, it still remains. Then you can set off against the other heads of income. If it still remains, then you have to carry it forward in the next year. And when you carry it forward, the brought forward losses can only be set off against the PGPP. Now that PGPP may not be the same source of income. It can be different income, different source. That is fine, but the head should remain the same. And the person who has incurred the loss should be the same as the person who is setting off the losses. Meaning the successor of the business is not allowed to carry forward or set off the losses except in the case of succession by inheritance. We will see that in the next class.
Legal heir.
Yes. And what is the maximum period for set off of losses? 8 assessment years. Are we clear?
Ma'am, losses is, I think losses is unlimited period, I believe.
No. For business, it is 8 years, not unlimited period. That is for unabsorbed depreciation. For
Only
UAD, it is unlimited period. For the business losses, it is maximum 8 years. Clear?
Yes,
Fine?
ma'am. Fine. Yeah, fine.
Okay. Next is the carry forward. So 72A, this is we will deal in the next class, 72A and all of these section, because this will require some time. 72A, AB, all of these sections. Yeah. Next is losses in speculation business, 73. Speculation business is a distinct and separate from the other business. So losses in speculation can only be set off against the speculation income. And once it is carried forward, this can again be set off against the speculation business only. What is
Only
the maximum? Yeah,
maximum period is 4 years only.
correct. Maximum period is 4 years. Now, if you remember, while we were dealing with PGBP, I told you what is speculation income. The derivatives, the FNOs are not the speculative businesses, right? If you recollect, I can take you back to our PGBP first class. So what we had discussed that time.
Yes, ma'am. The future and the option and derivative is
Correct.
not part of the speculative.
Correct. Yes. So we had discussed that time that what is considered as the speculative business, right? So the speculative business which is there we had made a reference to 73 also, if you recollect. I'm not able to find it. Yes. So transaction of contract of purchase or sale of the commodity or stock or shares is settled otherwise than by textual delivery, which is basically intraday. Trading or hedging through derivative is not speculative. And then 73 said where the business of the company involves purchase and sale of shares of other company, that is deemed to be the speculation business. This is what 73 says. The exception is where the GTI of company consists of interest on security, IFHP, capital gain, EFOS, or where the principal business of the company is trading in shares, banking, granting of loans in advance. Then it is not considered as speculation business. Right? Do you remember we had done this already while we were dealing with 43?
Yes, ma'am.
Yes. So it's the same thing. Now what is the time period here? We discussed 4 years. Again, specified business losses can only be set off against the specified business income. Under 115 BAC, you are not allowed to do that because you don't get the deduction under 115 BAC of 35 AD. So it can only be set off against a specified business only when you have the normal business income. Are we clear? Any questions, any doubt? And these losses can be set off indefinitely. These are the losses where there is no time limit. Here you can set it off indefinitely.
Ma'am, I
Clear?
had a
Any questions, any doubt?
yes, ma'am.
Fine. So when you set off the losses of any specified business, which
Ma'am,
is
I
eligible for deduction under 35 AD against the profits of the existing business, in respect of hospital or a hotel, even if the later is not eligible for deduction under 35 AD, then also you are allowed to claim the losses with respect to that. That's what the provision has been allowed. Yes, please go ahead.
ma'am, FNO and intraday is not a specified business for
Speculative
normal
business.
speculative. Sorry,
Intraday is a speculative business, FNO is not.
so FNO is what category?
FNO is normal business.
Normal is okay, ma'am.
Next is loss under the head capital gain. Short-term capital loss can be set off against long-term. Long-term can only be set off against the long-term. Maximum period is again here 8 years. Clear? Any questions, any doubt? Yes or no? And the last one is owning and maintaining racehorses. Again, this is allowed for 4 years. This can only be set off against the same income. And this includes the income loss incurred from the activity of owning and maintaining racehorses. That's it. So here basically what they are trying to say that only when you have this owning and maintaining racehorses income, you can set it off against this particular income only. Are we clear? Any questions, any doubt? Fine. Yes? Any doubt,
Clear, ma'am.
students? Fine. So what should be now the order of the set off of losses as per 72.2? First, you need to set off the current year depreciation. Fine. Because that's your current year depreciation expense. Then current year capital expenditure on scientific research and current year expenditure on family planning. Because again, these are the deductions allowed to you. Then you should first set off your brought forward business loss because it has a time limit of 8 years. Then you should utilize the unabsorbed depreciation because that you can carry forward indefinitely. So you should keep it for later. And unabsorbed capital expenditure or unabsorbed expenditure on family planning. So this is what your order of set off should look like. Fine. Okay. Next is submission of return of losses. Now, only when you file your return of income on time, right, on time under 139(1), not a belated return, then only you will be allowed to carry forward and set off losses, which is business loss, speculation business loss, specified business loss, capital losses, and losses from the activity of maintaining racehorses. House property loss you can set off and carry forward irrespective of whether you filed the return on time or not. Even if you file it belated, you can still claim the house property loss and even the unabsorbed depreciation. Okay, so we'll stop here for today. If you have any questions, I'll be here to answer. Otherwise, we can just stop. And in the next class, we will continue discussing this particular lecture. Fine?
Ma'am, give some examples for speculative business, ma'am.
Speculative business basically intraday where you purchase and sell, you do the short sale, you do the basically for example you purchase without taking the delivery of the stocks and immediately sell it. You don't take the delivery. So when you do it in Zerodha, Kotak or HDFC anything, you see an option of intraday where the stocks do not get credited to your account. You only play on the margins. That's where it is speculative. Fine.
Ma'am, if partnership firm is also engaged in business of intraday, then it's income is
Speculative.
normal or speculative.
Speculative.
Okay, ma'am.
Any intraday speculative FNO is normal business. Okay.
Okay, ma'am, got it.
Fine. So we'll stop here for today. Thank you so much and we'll meet on Thursday.
Thank you.
I think, Geet, you have a question. What is meant by income from owning and maintaining racehorses against which loss for owning or maintaining is being set off? Does it mean winning stakes from betting in racehorses? Yeah. Geet, so basically, let's say for example, when you maintain these racehorses, right, and you basically derive the income from betting it, basically, like from a horse race, uh, or from, let's say, the loss incurred in the activity includes the income by way of any expenditure incurred, right? With respect to the stake money, which is basically, you put that particular money in respect of that particular horse. So these are the losses that are allowed in this particular case. So any prize money minus the stake money, any kind of this expenditure that you incurred for that horses. So that is the loss which is there. Clear?
मैम
Yeah.
ओनिंग एंड हाउसेस का मतलब इन द सेंस विथ रेस्पेक्ट टू द पर्सन जो बेट लगाता है उसके पर्सपेक्टिव, राइट मैम?
ना जो मेंटेन कर रहा है हॉर्स को,
ओके
हॉर्स को मेंटेन कर रहा है उसके पर्सपेक्टिव से, जिसके
ओके, ओनर
हॉर्सेस
ऑफ द
है,
हॉर्सेस, ओनर ऑफ द हॉर्स
ओनर ऑफ द
उसके
हॉर्सेस,
हिसाब
यस.
से, ठीक है। और जो नॉर्मल बेटिंग लगाते हैं आदमी लोग अलग से,
That
वो
is not
लोग का
covered.
नहीं है?
Those losses are
अच्छा,
not covered here. We are not allowing the set off of those. This is only for the, see, those incomes also which winning from race horses, those are taxable on gross basis. You don't get any expenditure allowances against that. This is only covering for the owning and maintaining, because when you own the horses, you incur certain expenditure for maintaining them. So that is what is the purpose to cover here.
ओके मैम.
Fine. Thank you so much.
Thank you, ma'am.
We can close the session. Yes. Thank you.
धैर सर धैर सर 1 सेकेंड सर, मैं बात करता हूँ। अशोक सर, सर का नंबर मेरे पास एक्चुअली नहीं है अभी, तो ओके 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 सर, ओके ओके सर।
Recording stopped.